So we're getting a closer look at how rising inflation is directly impacting the U.S. economy and Americans' wallets. New data out today shows prices hitting their highest levels in 40 years, and inflation skyrocketed 7.5% over the past year alone. Today's numbers reinforce the Fed's signal that it will raise interest rates in the near future as Americans struggle to deal with soaring costs. So Michael Pond is joining us now. He's the head of inflation research at Barclays. So glad you're here. I am one of those people. I'm looking at the possibility of buying, a new car, not a new car, actually a used car, but to replace my old car, and it's not looking good. It's not looking good at all. What are your reactions to these numbers?
Yeah, it's not looking good, Anne-Marie. And used car prices are up 40% year over year. So you're going to pay a lot more than you would have a year ago. And overall, prices are up about 7.5% compared to a year ago. That's the highest level, as you mentioned, in 40 years. Mm-hmm. Now, we do think that most of the inflation pressures that we are seeing and are likely to see for the next couple of months are pandemic related. So it's easy to say that once we get through this pandemic, inflation pressures will come down. But clearly from today's report, we're just not seeing it yet.
All right. Well, can we talk about what role the pandemic may be playing and what it's not responsible for? It's been going on for 2 years now.
Sure, it's coming through many different channels. So one of the channels that is coming through is supply chain disruptions. I'm sure you and your viewers hear that a lot. Mostly when we think about supply chain disruptions, we think about imports from China or generally abroad, and that shipping rates are up, and that there's just a lot of delays in getting goods into the U.S. But another important supply chain channel is the domestic labor market. We saw last Friday that the U.S. added another 500,000 jobs, but that wages are also quite strong as well. So businesses are having a lot of trouble hiring workers, and that's another supply chain disruption. We do think that as the pandemic becomes an endemic and people are less worried about returning to work or don't have to stay home to take care of their kids if the child care places open up again as they had, or just people run out of fiscal stimulus that they'd gotten in their pockets from last year and need to go back to work. We do think that the labor supply issue will solve itself later this year, but there's a big question mark, and as you indicated, the Fed is dealing with that uncertainty and is more likely than not to start to really tighten policy at its March meeting.
Yeah, so the big question is, what can we expect from the Fed? It seems like the expectation is that they're going to go slowly, that there'll be a small increase in, a small increase maybe in March, and then some more small increases further months along. But can we expect that, or could they go a different route?
Well, that is what we expect in our baseline case. But the risk certainly is if inflation stays high, they want to make sure that they get ahead of any rise in inflation expectations, and they may end up hiking faster than what we have in our baseline, even with perhaps a 50 basis point hike in March. Again, that's not our call, but if the Fed is in risk management mode and wants to make sure that they're not seen as behind the curve on inflation, both from the outside world and politically, they may hike faster than we think they will, given our baseline. There's just a lot of uncertainty. We expect that by the end of this year, again, inflation pressures will start to fade, and that the Fed will not have to be as aggressive as it might be if inflation stays right now. But there, as I said, the outlook is quite uncertain. Yeah,
I bet you there's a lot of people that find themselves in this sort of catch-22 situation like I do, where I want to buy a car, but they're expensive now. But if I wait, will the interest rate go up, and now I'll be paying more to borrow that money? I don't know what to do. How will rising inflation affect Americans long term?
Right. It's certainly a bit of a dilemma, and that's why the Fed wants to make sure that they bring it down over time. They're not necessarily looking to crush the economy, as Volcker did in the early 80s to bring inflation down quite rapidly, but they want to make sure that it proves relatively transitory and doesn't last beyond the pandemic forces that we're seeing now. And interestingly, what we're seeing in the markets is that the market largely has credibility in the Fed's ability to bring inflation down. So if we look at what the market is pricing inflation for next year or in 2024, 2025, they're not far above the Fed's 2% inflation target. So the market largely expects the inflation to come down to the Fed's target below 3% by next year. But if the Fed doesn't act, the risk is that the genie's out of the bottle and it sort of has a self-propelling mechanism.
All right, up into the stratosphere. Michael Pond, thank you very much.
Thanks for having me.